Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what's going on today. If you want to follow me, it's at Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these sectors, topics, looking for investment opportunities and sharing them with everybody in the community. I do that through midweek updates, which I release on Wednesdays, and I do that through Q&A sessions on the weekend, either through a Saturday or Sunday Q&A session that you can attend and ask whatever questions that you like. And I will try to help you and give you my opinions and tell you what I am doing in those cases or circumstances or whatever the question pertains to. Special is a coupon code that we have. It is a $25 charge or $25 off the first month on a monthly membership. It is a $500 charge using that special coupon code. If you'd like to sign up for the yearly membership, you can always swap from a monthly to a yearly. Coming down to Nugget Capital Partners, it says good interview here with Mike Rose. I believe he's the CEO of Tourmaline up in Canada. It says not my cup of tea except when he sells off aggressively and we can capture the swing, but makes sense for long-term holders. He thinks shale gas is going to run dry and they will need to pipe the Montney to the USGC for export. That's a big one. I hold the same opinion. I think between now and 2030 that we do not have the supply of natural gas in America to meet all of the exporting demand from LNG, from AI, artificial intelligence demand for electricity in our nation. So I think things are going to get real interesting here for natural gas. It doesn't mean that I'm talking about the price today or next week, although I do think pricing will strengthen here probably over the next few months. I'm talking about the next 5 years. I think we're going to see tightness in world oil markets and in world natural gas markets. And whoever has exportable capacity left is going to be the most valuable in the world. So whether that's natural gas in Canada or oil in Canada or other areas in the world that have any export capacity left, they will be the most valuable barrels of oil because people will be fighting, hopefully, with their dollars and not bullets for that export capacity. And it's coming. It's coming. And the best setups are the ones where everyone views something bearish in the short term, but the bullish long-term outlook is favorable. So it's a bullish long-term outlook with a bearish short-term. Again, we're seven standard deviations on the cheap side against gold. Oil is for how cheap it is. So we have an anomaly on how cheap it is, and I think we're going to go all the way to the other side of that ratio. Let's say below 10-to-1 ratio. So we're about 70, a little over 70 barrels of oil to 1 ounce gold. I think we will go below 10 at some point in the next 5-ish years. So maybe 2030. And that's going to be the big, big move. People won't be able to see that. They won't be able to envision that in the current market condition. And I think that's where you kind of have to look beyond that, the current market condition, to get bullish on oil, nat gas. So again, I think we're going well over 250 a barrel on the price of oil by the end of this bull market. And then here's another thing. If the oil doesn't show up And I don't. Maybe it will. Maybe we'll figure out ways to do something. I don't know. We'll see. But if the oil doesn't show up, maybe we have a much higher sustaining price. I think that's going to be the case across the board for all commodities. I think that we're going to break out of the old regime, the old price channel. Maybe I can bring something up to explain what I mean by this. So we'll look at copper here, and we'll do a long-term chart of copper, um, kind of like logarithmic. So this was a price regime, like a channel, was this channel here. Then it went to a new channel, and this is a channel here. And then I think what's going to happen is we're going to go into, this is the tariff news. We're going to go into a new regime, a lot of little things up there, a new regime where we're going to create another channel up here perhaps, where pricing is going to go up to an entire new area. So this is channel one here, channel two, and then channel three. And that's going to happen for every single commodity. They're all going to jump a channel higher. So this is copper that we're viewing right now. Crude oil is going to do it too. I think that 150 will be the new base. So if we draw a line kind of across like this, so like 120, 130 will be like the new base. So we'll draw a line across here. So this is the one before it, basically. So the majority of trading occurred here. Majority of trading occurred here. And then eventually we'll get a new majority of trading that's going to be another base higher, which will be up in here in like the $200 range or something like that. That's what I think will happen. And then and they will do that across the board: copper, zinc, oil, gold, silver, platinum, palladium. Platinum, it's the same thing that happens over and over. You get this channel there, like that's the channel that it trades in. This is a new channel that we've traded in, and then we're going to go into another new channel that will trade in up here, maybe around 4,000-ish dollars or something like that. Will be the average price. So maybe we will originally go way higher, like $8,000 to $11,000 or something. So we'll reach like somewhere up here, but it will do a pullback, and then it will do something like an average will be 5,000 or 4,000 or something like that. So that's what I think will eventually transpire. And if you've got like some of these guys talk about, one of them is Adam Waterous. If you have low decline, uh, heavy oil, you can sell that into the market for very high prices for a very long time. You're going to make a ton of money. A ton of money can be made here. So I know people are worrying about the short-term price movements. Don't worry about the short term. Longer term, bigger picture view. Look at the big picture. Look at the end game, and look at these charts as guides for for whatever life you have left. If I have, let's say, 40 years left on this planet, I can invest in oil, run it up into that upper area, and then collect dividends all the way up there for a long time. So that's kind of like how I position and what I think of and the vision that I have for investing over the next 10, 20, 30 years. The average car in the US highway is now almost 15 years old, nearly double what it was in 1995. And this is the average age of the passenger cars on the road. It's 14 years old. And I'll be honest, guys, I really don't like the new cars. I don't like any of the electronics. So I drive old cars, and I like old cars. And what's an old car? My car, we have a 2004, 2004, 2005, and a 1993. Those are the age of the cars that we own in our family. I am well aware that some of them are getting pretty pretty weathered, is what I'll say with one of them. But I like the old cars. I don't like the electronics inside of them. So I like I think the sweet spot was the 90s Japanese cars. I love those cars. I also think The 2000s cars were really good, like the RX-8. The MR Spider was kind of cool if you put a different engine in it. The S2000 was really cool. I like all those types of cars back then. All the new stuff, I don't like any of it. Boring, nasty. So I don't know if that has anything to do with it. I highly doubt it. New cars are also extremely expensive for what you get. So I don't like the electronics, and I don't like a lot of the new cars. I just like the old stuff for whatever reason. I think it's more of a raw driving experience, which I really like. Lauren Boston says, looking at gold's recent volatility, I'm reminded of how the German mark traded relative to gold in the early 1920s when the currency collapsed. Gold in US dollars is showing a similar volatility pattern. Watch out below. Look at the volatility here in gold. There was some pretty nasty percent negative changes before it went hyper inflated vertical. So, um, is this sell off the top? I don't think so, guys. Could it be a short term top? It could. Definitely could be a short term. Maybe we get a consolidation. Maybe we don't. I'm much more comfortable living in the uncertainty world of it. I haven't sold any of my precious metals since acquiring any of them. I've done a trade or two, yes, but I haven't sold anything and swapped it into dollars or anything like that. So yes, I've made some trades, but I don't see this as any big deal, and I don't let the price worry me. I look at the fundamentals, I look at interest rates and the direction of interest rates, and I say, we're going to go higher, and that's all I do. I don't worry about the short term market movements where people get all sorts of worried about. If we pull back, okay, no big deal. I'm not going to sell any physical silver. I'm not going to sell any physical metals. Why would I do that? We're in uptrends, guys. We're in uptrends. So could we get a consolidation? Yeah, it definitely looks like that's what's occurring. But am I worried? No, I'm not worried at all. I think all of the long-term fundamentals are all intact and nothing's really changed. Joseph Brown, it says, not about Bitcoin, but all of life is about asymmetric risk. Make enough small bets that have enough upside that if only a few of them pay off, you win big. That's exactly how I set up my portfolio. If none of them pay off, you'll be fine. Never take any bet that risks blow up. That is, if it fails, it wipes you out and you can't recover. For any risks you have no choice but to take on, hedge as much as you can. For example, choosing to stay alive risks death. So if you have dependents, get term life insurance. And I think that's pretty good. Um, you know, bet small to win big and take all the bets that you can is what I would say. Taking zero risk is also another risk because if there's no upside, then you live with a life of mediocrity. So you have to take some risk somewhere at some point, but it doesn't mean you bet everything. You can bet a small amount, take the risk. If you lose, it doesn't wipe you out. That's exactly how I set up my portfolio. The riskier something gets, the less I put into it. But I want the big asymmetric payoff. So if there's no asymmetry, if I'm doing a symmetrical bet, a 1-to-1, and it's a very risky bet, there's no way I'll ever do it. I won't do it. Now, if there's a risky bet, but the payout is 1,000-to-1, I would do it, depending on what I think the probability is. If the probability is just 10%, I would still do it because the payout is so big. But then you have to sit and you have to figure out how much do you want to risk? How much money do you want to put and allocate and put at risk into it? That is the conversations that you need to have with yourself when you're putting positions on in your portfolio. You need to figure out how much risk is this? what is my potential payout? Now, you won't know what the potential payout is. That's all an estimation. But you can get a good idea of maybe what the downside risk is. And if there's very little downside risk, like let's say, for example, you've got platinum trading at 14 years sideways, and it's below the cost curve of all of the producers. That's a very low risk entry point. So then you have to figure out, well, what's the upside on it? And if you've got a lot of upside, you've got a pretty good, strong, we'll call it a strong case for putting in a sizable position in something that doesn't have a lot of risk, but good upside potential. But everything is a function of opportunity. So you have to weigh that opportunity against the other opportunities that are out in the market. So you're weighing this, hey, we're below the cost curve, super low risk if you buy the physical metals. Maybe it's got a 4 to 10x payout to the upside. That's a pretty solid asymmetrical bet in terms of risk reward. So then you have to compare that to other things. Maybe there's a junior silver company that's bottoming. And you're saying, well, that's really good. And the payout could be, 15, 20, 30 to 1. So then you compare that payout with the risk, and you compare that to what is maybe less risky and that payout. And then you have to make a decision. Do I put more money into this? How much money should I put into it? Should I go with the really risky option and try to go for a little bit better payout? And what I would do is I would always favor the more probable payout. So if you've got silver, physical silver, or physical platinum that's trading underneath the cost curve, I would always put a lot more money into the less risky, big reward bet and cover myself with that. And then with the smaller, more risky option, I would put smaller amounts into it. So that's kind of how I would look at this. Gary says the current precious metals bull market will follow similar patterns to previous secular advances, with multiple corrections along the path to much higher prices. The fundamental drivers suggest this bull market has years left to run, making current corrections opportunities rather than threats of properly prepared investors. Well, okay, I'm going to go back to this, guys. Everyone knows the price of everything and the value of nothing. And what you want to do if you're a longer term investor is you have to focus on the secular trend, the long trend. You have to know what the drivers are for gold going higher. And as long as the drivers are in place for it to go higher, we're in a bull market. So I will be a bull in gold as long as the long-term drivers are in place, aka inflation and increasing interest rates. Now, in the short term, you're always going to have a pullback at some point. You're going to get it. So that's what you're weighing it against. Another thing that you can do is you can look backwards. Look backwards and look at the different market conditions and then compare those conditions to the conditions we have today. Are they the same? Are they different? Are things changing? Why did gold go up in the past? Is it going up for the same reasons today? And compare it. Gain conviction from that, from history. Because I think it's the same market conditions under history that gold has gone up under. Increasing interest rates and inflation. This is from Michael Oliver, Momentum Structural Analysis. This panic sell in PMs that began Friday is now firing the same buy signal we had in response to the tariff drop at the end of March and the correction at the end of July, early August. Some hopium for everyone. I'm not even worried, guys. I'm not even worried. So I've been a long-term holder. I've acquired a lot of physical metals. I am never going to sell my physical metals unless I want to spend it for some reason. But I'm never going to not have a position. So I can swap the position. I could swap it from silver to palladium and palladium to gold and platinum to gold or whatever. But I won't ever have zero. I view it as savings. So maybe if you get scared, view it as something else. View it as savings. View it as a way to be out of the system. View it as something, however it makes you feel better and be able to sleep at night. Um, I've been in precious metals for a pretty long time. Since the mid 2000s when I started working, I bought some. I originally bought a little bit of silver. I bought some palladium, and that was basically all I was writing. I bought some gold later on, but I was mainly writing those. I bought some gold in 20, what was it, 2012 or 13, I think. I bought a whole bunch back then when um, I moved from Minnesota to Colorado. So I moved and I sold a house. So I had, some money and I threw it in the physical metals because I wasn't going to buy a house immediately. So um, I did that, and I just view it like I don't ever want to not have physical metals. So I don't know. It's easier to hold for me. Shabam says onshore crude inventories globally are still in a healthy range thus far. Although oil on water has built, OPEC plus exports are down significantly in October versus September. Global demand is running at seasonal all-time highs, and the majority of excess Chinese inventory is in Shandong. So we're not building hugely yet, at least, and we'll see what happens. Coal has fallen more than 75% from its September 2022 high and now trades near its lowest price in almost 4 years. You know what that says to me? We're close. I love this setup here. I love coal. Remember what I said above about Mike Rose? Mike Rose made a comment. He said, let's read it again because we've got coal here. So the comment is he thinks shale gas is going to run dry and they will need to pipe the Montney to the USGC for export. You know what coal's going to do if we run dry and people panic? This is going to go up dramatically. If it's down 75%, well, we can put, some investments on where people aren't looking. People don't think, I don't think there's a single person right now that thinks natural gas will be a problem in America. And we can put stuff on when it's cheap. It's exactly when you do it. You got to play chess, not checkers. So you want to position when people aren't looking, when the price is down 75% from its highs. That's when you get aggressive. And we've already been aggressive in some of this. Some of them have already gone up dramatically. Robert Friedland is warning over the next 18 years, humanity will need to mine as much copper as it has over the past 10,000 years combined. Read that again. In the next 18 years, we will produce more copper than what we've produced over the last 10,000 years combined. This comes at a time copper supply is very fragile. Guys, we don't have it. We don't have that. I don't think we have it. Like, I don't think that we are going to produce that much copper in 18 years that we have in the past 10,000. Now, we've got a whole bunch of crappy, low ore grade, small mines around the world. They're all over the place. Now, compare this. Okay, this is where I see a problem. Okay, it's as easy as it can be. When I read a comment like this comes at the time when copper supply is very fragile, right? And we've got all this demand coming for copper. I go and I look out and I look at the mines. They're all low grade, like below 0.5% ore grade. 0.2, 0.3. That's all the new stuff. And it's real small crap. I go back up here and I read Mike Rose. Shale gas is going to run dry and they will need to pipe the Montney for the USGC for export. So let's add these things up. If we hit a problem in energy, natural gas, or even oil, and we want to produce as much copper as we have in the last 10,000 years in the next 18 years, where is that energy going to come from? Where is that going to come from? If we are going to mine incredibly low ore grades at increasingly exponential, it's an increasingly exponentially more energy intense process to mine ore grades that were 5 and 10% in the past 10,000 years, and now we're doing 0.2% ore grades. That takes a lot more earth moved to get the same amount of 1 ton of supply of copper. So we need to move a lot more earth to get a lot less copper. Where's that energy going to come from? If natural gas is going to run a little bit dry and oil starts to have problems, say shale oil has peaked, where's all this going to come from? And we want to do 18 years as much mining as the past 10,000 at ore grades that are less. That doesn't make sense to me. Then I go look at coal and it's 75% off its highs. Do you know how much coal we are going to burn if we have a logjam in energy? I mean, we are going to burn the living crap out of it. Everything is moving at exponential speeds, and people don't understand and they can't fathom the exponentialness. We think linearly. So it'll be like, oh, we've got 50% of reserves left. That means you have less flow rate out of oil, less flow rate of natural gas when you have 50% reserves left. The problem occurs when you lose your high energy return on investment oil and natural gas and coal, and you convert into a world where everything is much scarcer, where oil is scattered amongst smaller deposits, and copper has less ore grades scattered amongst smaller deposits. It gets harder. So we're not on flat land cruising on a bicycle. We are pedaling up a mountain. And as you say, we need more and more and more, you need to pedal harder and harder up a steeper mountain as you move, because the ore grades decline and you're shedding off easy access, high flow rate oil and putting in low flow rate oil and harder to get stuff. It says gold and tech stocks, are you paying attention as gold still outperforms the NASDAQ? We're going to break out here, guys. Yes, we got some selling pressure. They're trying to manipulate all this, in my opinion. They're trying to hold it together for the NASDAQ and S&P. Here's another thing. You know how I've been sharing all of the crypto things on Twitter? How they've been spamming everything, sell gold, buy crypto? Do you think it's by any chance just so happens to align with the pullback in gold? Let me tell you what I think they're doing. They're sending out all that stuff to send out subliminal messages as people read it. Then they see the market, they get scared as something sells off. It's like they're trying to control everyone through the news and through Twitter and whatever else. I'm not buying the bait here, guys. I'm staying heck of a long in gold, silver, and commodities until we get expensive. Here's the Bloomberg Commodity Index, X precious metals. It says we're still very, 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 very early. We haven't really moved much. We've just been basing out here. And that's excluding precious metals. Teddy says OPEC no longer will have much spare capacity. It says oil just hit 57. Where are we in the oil investment cycle? While everyone's panicking about the end of oil, we're witnessing the textbook setup for the next major bull market, where what actually is happening beneath the noise. The perfect storm of desperation. WTI crashed 25% since January, deepest fear since 2020. 47% of global production is now at or below break even. 1.2 billion barrels are floating at sea, highest in 2016. Warning of sub 50 oil. The math doesn't work. You can't run an industry at break even indefinitely. Permian break evens are 61 a barrel current. WTI is 57. Production cuts aren't coming, they're already here. So we're probably laying the foundation of the next bull market in oil right where we're at today. It doesn't mean it can't go down more. We're laying the foundation of it today. Posted many, many charts 1.5, 2 years ago saying precious metals would have a big move from there. Also called the big breakout for gold and silver in real time back then. One of the chart of all posted back then was the link post below showing that gold miners were turning versus tech companies. They did, and has had a huge move since then. Now the ratio chart below has also broken out above the pink inverse head and shoulders. Make sure you're on the right side of this one. As said for 5.5 years now, since called the bear market low, this commodity bull market will be the greatest opportunity in our lifetime. And here we are breaking out. I know we've got a little bit of selling pressure ahead of us. It's in our face now. But the charts all suggest that the big long-term secular bull is all intact. So what am I going to do? Nothing. I'm going to sit, wait, be in it, have exposure to these sectors. JC Parrott says 100%. So Stanley Druckenmiller says contrarian investing is way overrated. It is intellectual cool to not be with the crowd, but the crowd makes money 80% of the time. I think you need to be a contrarian on your entry point. Then you ride as far as you can, even if the crowd is jumping on. So I think, yes, the crowd may make some money, but I think it's also important to be a contrarian in the beginning to put on your positions with the lowest amount of risk. Here is one, lower supply but higher oil on water. How is that bearish? The hype of oil on water. It says analysts and journalists overlook several facts. The amount of oil on water is smaller and the impact on the oil market is significantly exaggerated, in his opinion. And that's all I've got for today. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials that coupon code. And that's all I've got for today. If you guys are interested, I did release the midweek update for my opinions on individual companies and sectors. So check that out if you haven't, and that's already uploaded to the website. See you guys.